Hello, everybody. Welcome back to another exciting episode of As the FOMC? FOMC? There's got to be a word in there somewhere. Churns, burns. Who knows? Good old Brian here in the saddle for another FOMC meeting here. I don't know whether there's any value in this broadcast or not. Maybe you can comment, like, subscribe, all that kind of fun stuff. Whether you find any value in this. Jerry will be speaking shortly. I don't know whether Chris has. I don't want to move that because that's going to screw all that up. But oh well, it's done. Did Chris? Did you send me a YouTube link? Is that this? That's the YouTube link from this morning's show. So we do a show on the site Monday, Wednesday, Fridays. I do, and then of course we have your Sunday free show for the public. Let's see if I click on this. Let's see what happens. Boom! There we go. Let's see what the heck Chris is showing you. Sure looks to me like the knee-jerk reaction. Of course, we just had the Fed announcement. They are cutting rates. Actually, not they are cutting rates. They have cut rates. Uh-oh. They kicked me out of the darn thing. Let's see if I can get back in there. Oh, and there is the press conference link. So I suppose as soon as that starts up, good timing for the guy to start working on his lawn outside my window, though it's across the street. It's a bit surprising. Anyway, hopefully you don't have to hear that on the social media channel. Okay, looks like I logged back in successfully. Has this started? Oh, I see. So I'll put the broadcast over here. I've been noticing recently playing YouTube videos. The audio comes through on Discord. I don't know whether it comes through on YouTube or not. Okay, let's try it one more time. Can I get the YouTube show to show? Anyway, as you can see, Fed just cut interest rates down in the States. Nope, that's the link to the FOMC thing. Do we have a link to our studio? There we go. I'm sure you're all enjoying this scrambling here. So back to 4% now, I suppose. Although I did see a reference. I don't quite understand this, but they have like the target rate. And does the target rate, does that mean that they only have to pay you 3 3/4? Anyway, thought I saw that somewhere. Anyway. Hello, Goose. Hello, Kitchen and Craft. Hello, German Liz. Hello, Ursus. Hello, Nore. Hello, Alexa. Hello, Pipi Rupito. Oh, you're over there too, eh? Oh, now he's out of the Zoom call. All right. Well, anyway, Ezekiel. There's a name. Cool. And hello, Baja. Baja. So, got a few minutes here before Mr. Powell starts speaking to us. I guess a quick review of what I'm seeing in the market. The old Bitcoin here kind of flaked out at a level that we've been kind of thinking that it might flake out at. So not really a big surprise. We'll see how long does this take to actually start making W's again. Might be a while. Having said that, part of our matrix that we'll be watching here. This is a 30-minute overview of everything I like to watch in sort of one shot. There you can see the crypto market looking kind of heavy, although it is interesting to see Litecoin bucking the trend. There's the total crypto market. Did break through key support there this morning. So in a bit of damage control mode, I suppose, right now. Interesting how the total 3 not breaking down. So I think this correction is really more Bitcoin is specifically related versus crypto. Stocks looking kind of heavy here. especially the Russell 2000. I've been noticing Russell 2000's been underperforming, and the breadth of the market. I did find it interesting that heading into this event, the TRI platform breadth signal, which I think is pretty good value for your money spent. It's been showing a bit of stock market underperformance lately, and I've been noticing that out of the Russell 2000. It's not participating in this most latest move up. And we have been sort of seeing that on the bigger picture. Question is, which screen is it? Over here? No, not that screen. Over here. Watching all of the indexes. Here we are here. See the Dow powering to new highs, but there is problems with this in that the Dow theory is disconnected here. We're actually getting a Dow theory sell signal. Transports are not moving to new highs. Industrials are, so that's a bit bothersome. But you can see Dow powering to new highs, S&P rocking and rolling, NASDAQ. Interesting NASDAQ. Look at all the divergences that are building up here. And 8s and 9s. But notice how the Russell 2000's underperforming. So a little bit bothersome there. And, January barometer has been suggesting trouble. Also, too, out of the thinking of today, he is? I don't see the video actually playing. Okay. Well, let's head on over, listen to what Jerry has to say. Maybe we'll do a review after he's done. Grab that over here. Hey, there we go.
Support of our goals and in light
all right, I'll
of
put myself on mute.
Of
course, I'll bark in if I see
today,
something or
the
hear
Federal
something.
Open Market Committee
Let's
decided to
listen to what
lower
he has
our
to say.
policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue
Somebody
to decline.
just did something.
In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal.
NASDAQ's taken off.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted
just
to the
double-topped.
upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the
Hello.
committee's discussions
What the
at
fuck?
this
I bet
meeting,
Trump's
there
saying
were
something right
strongly
now.
differing views about how to proceed in December. A further reduction in the policy rate at the
Wow,
December
look at that
meeting
US dollar
is not a
go.
foregone conclusion. Far from it.
Woo, look at the stocks
Policy is not
dumping.
on a preset course. At today's meeting, the committee also decided to conclude the reduction
I talked
of our
about this
aggregate
in
securities
today's,
holdings
site
as of
video.
December 1. Our long-stated
There's
plan
nothing
has
that
been to
Jerry's
stop
saying right
balance
now
sheet
that would
runoff
cause
when
this.
reserves are somewhat above the level
Chris,
we
can you
judge
keep an
consistent
eye
with
on
ample
Twitter or
reserve
whatever
conditions.
for what the hell's going on in the
Signs have
world?
clearly emerged that we have reached that standard. In money markets,
Anybody
repo rates have
watching the
moved up
video? You
relative
guys
to
got a
our
news
administered
feed or
rates,
something?
and we have seen more notable pressures on selected dates, along with more use of our standing repo facility.
Something's
In addition,
happening.
the effective federal funds
And
rate
I have a
has
feeling it's
begun
got
to move
taco
up
written
relative
all
to the
over
rate
it.
of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet,
Look
our
at the
securities
bonds
holdings have
just
declined
cratering.
by $2.2 trillion. As a share of
Wow.
nominal GDP, our balance sheet has fallen from 35% to about 21%.
I bet you the news reporters are like,
In
what
December,
the hell's
we'll
going
enter the
on?
next
Get
phase
your
of our
phones out.
normalization
Something's going
plans by
on.
holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities
Something
such
just
as
hit the
currency
fan.
keep growing.
Interesting how Bitcoin's the first thing that
We will
turned
continue
back
to
up
allow
here.
agency securities to run off our balance sheet, and we'll
Look at
reinvest the
that US
proceeds from
dollar
those
go.
securities
Holy
in
crap.
treasury bills, furthering progress toward a portfolio consisting primarily of treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations
Somebody
well anchored.
just liquidated
Our
a
success in
huge
delivering on these
position.
goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
Should have been writing some
Thank
call
you.
options.
I look forward to your questions.
There's that wheel strategy guy.
Nick Timmeros of the Wall Street Journal. Chair Powell,
Holy
are you
moly.
uncomfortable with how
Somebody
market
just dropped a
pricing has
bombshell.
assumed a rate cut is a foregone conclusion?
Well, look at the US dollar just keeps,
Well,
US dollar
as I
on the
just
4 hour
mentioned,
just confirmed a bull
A
flag.
further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, just say this, 19 participants.
And
on the
everybody,
committee.
didn't somebody in the
Everyone
chat say,
works
you know
very hard
what,
at this
I'm
and takes
going
their
all in on
obligations to serve the
Bitcoin
American
here.
people very seriously.
I thought
And
I
at a
saw that
time when
earlier
we have
somewhere.
tension between our two goals. We
Ouch.
have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway
Gonna
from that is
gamble
that we haven't made a
on
decision about
Truns?
December. And, we're going to be looking at the
Oh,
data that we
Trump's
have,
ego?
how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook? Or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed.
Oh, a
And as we
US
saw
dollar.
particularly after the July meeting, we saw the downward revisions in job creation. We saw a very different picture of the labor market and suggested that there were higher downside risks to the labor market than we had thought.
Gonna be interesting to
And that
see how the
suggested
talking
that
heads spin
policy,
this
which we
today.
had been
Holy
holding
moly.
at a, I would say modestly, others people would say moderately restrictive level, needed to move more in
Fed
the
cuts
direction
rates,
over
markets
time of
tank.
neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So
Wow, look at
if that
Bitcoin
got back
go.
into balance, then you'd want to be roughly at neutral. So in that
Well,
sense,
look
it
at,
was a risk
I mean,
management.
what do you say here? The whole
And
fucking
I would say
market's
the
in
same
free
about
fall.
today. Sort of the same
Holy
logic. But
crap.
as I mentioned, going forward is a different thing.
Did anybody hear Taco say anything?
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the
Oh, I like this.
the
lady.
discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or
All right,
a
here
downtick
comes the
really in
bounce.
openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some
Watch the
comfort.
bonds here.
But if this shutdown lasts
Look
a
at
while
crude
longer and you don't
bottoming.
have that
That's
data in
interesting.
hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right
Big drawdown in
policy
energy
decisions, and
stockpiles today,
also how much is that
reported.
factoring into the debate about December?
Yeah. So, we get, like I mentioned, what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call
Steve.
maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly
Bonds
declining
just can't
quickly.
find a
It may be
friend
just continuing
here.
to gradually cool. And again, people have different forecasts and expectations about the economy and different
10-year breaking.
risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically and because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time,
Organically.
but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with, the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be. Right now, it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected. We
Market
always
sure
break it
is
down into
trying to
three
bottom
components.
there, right?
So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case.
Wow, what a
is
good
that it will
lesson
come,
not to trust
and
the first hour following a
it
Fed
probably will
announcement.
increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be one-time inflation. We understand fully this is a risk we have to monitor and ultimately.
Aussie dollar catching a
With the
bid.
stubborn in services inflation, what are some of the things that the Fed could do to address that? And especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling
Did he
labor
just say
market,
stock
is
prices
because,
should come down?
The Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that
Good
you're right.
question.
There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. Could you mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you.
I could very easily see the government comes back and all the inflation data is like, oh, wow, this is way worse than we thought.
And that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the?
Looks like the bonds are trying to stabilize.
The December meeting. I'm not saying it's going to, but yeah, you could imagine that. What do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to be possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further
the serfs and
reduction
the
of
lords,
rates. It's not a
eh?
foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4%.
The market wants to come back here.
You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that.
Can you tell that guy's a
as I
Trump
mentioned.
guy?
Some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So
Ooh,
that leads you to
Swiss
people
franc
with disparate
cubed out.
views.
That's
You will
not
know
gonna
that
help
from
gold
the
prices.
speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're
Jeez, is the
150
US dollar
basis
gonna
points
break out
closer to
again?
neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth.
You can see the underperformance of
Thank you so much,
Ethereum
Elizabeth
here.
Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate
Russell
cut do to
2000 can't
improve
buy
the
a
job
friend
market?
here.
So I think there are two things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. So, and that's two things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and you know, so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply.
There goes the
So,
US dollar.
That's what's going on,
Wow.
but it is mostly a supply function. You know, it's mostly a function of the change in supply.
Man,
I
the
think,
bonds just
and
couldn't
many
find a
people
floor.
think. So the question then is, what does the you know, our tool do, which supports demand? And you know, so and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, doesn't, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, you know, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many
And
months ago.
unleaded broke out to
We see
new
those
highs.
effects, but if you put tariffs in effect, and they've been coming into effect consistently in, you know, February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think, you know, some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now.
That's
Now,
a
consumers
big assumption.
are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you know, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, you know, and it's nice that, you know, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to
You will
being
take your great
overvalued at this
resetting,
point?
and if you complain, there's your prison cell.
We don't look at any one asset price and say, hey, that's wrong. You know, it's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, you know, banks are well capitalized.
Oh,
while some
stocks are gonna like
households are
that.
clearly under stress. In the aggregate, you know, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not, it's not appropriate. You know, we don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think, you know, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not you know, about 25 basis points here or there. You know, we use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here to, by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately,
The AI
you know,
bubble
lower
shall
rates will support
continue.
more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, you know, I've told you the story. It's a complicated story, but this is the best assessment that we can make. But you know, because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why we're
Well, the old corn
pace we're
recovered
going has
nicely.
been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, you know, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different in the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and you know so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and you know it looks like they have business models and profits and that kind of thing. So it's really a different thing. You know, the investment we're getting in equipment and all those things that go into
Oh
creating
man,
data
these
centers and
semiconductors.
feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, you know, is much bigger than that, and has been growing and has defied a lot of you know, negative forecasts, continuing to do so this year. Consumers are still spending. Now it may be mostly higher end consumers, or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually,
The rich are
maybe growth as
spending.
opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is
Fascinating.
that the supply of workers has dropped very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs. because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution?
The
because of
data
uncertainty?
drought.
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but
Oh,
there will be an
Euro trying to
argument
put, look at that, it's cute little
you
trade
slow
setup on
down
the Euro.
when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look
Thanks,
forward
West
to,
Coast Wizard.
to,
That's a sweet comment by you.
I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see
Euro lost that bottom.
You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically.
Inflation's
which
good
were
for the
very
poor.
constructive. And we're not at that place right now. But so, yeah, I mean, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. I mean, inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Well, they're trying to bottom these currencies again.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
So British pounds trying to
Chair Powell.
outperform.
Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But, you know, we're going to be monitoring this quite carefully and making sure that that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, you know, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending.
The stock market
But,
wealth?
It wouldn't be. You shouldn't think that it'll
Hope you all have
dollar
some.
for dollar stop consumption, because that wouldn't be the case. Thanks very much.
And he's out of here. Well, there you go, folks. Sure hope you enjoyed it. Give me some feedback here on the YouTube channel. You guys want me to do a bit of a market review here of coming out of this, or should we just wind it up? If I have 5 people say, yeah, review, then I'll go ahead. Do 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 do. Ah, there's 5. Even with the YouTube delay, you guys still beat the time deadline. All right. Oh, actually, look at that. Hey, a short one. 2 hours later, Brian's still talking about double bottoms. All right. Let's take a look at what the hell happened here today. I guess we'll put the Fed thing away. Chris, you still with me? Have you got a stopwatch running? All right. All right. So we had Peaky Rubito in the Zoom call with us, but I think actually he went over to the YouTube page. Anyway. All right. So what the hell happened in the world here today? The thing that jumped out at me, I couldn't believe this. Holy free holies, right out of the gate, eh? Big old breakout in the US dollar just as he was getting going there. And we never did hear anything from Taco, eh? Oh, thank you, Bleeding Crypto. You're awesome. Love that. Hugs and kisses. And I was watching this 4-hour candle high so closely. And you heard me say, what was it? Now somebody posted Sedona. Hey, what happened to that Arborea? Why'd you get rid of that? You posted a Sedona. I think we're going to call the new show in the new year the Sedona Euphoria Report. And I have to wear a purple wig. Anyway, so right out of the gate, you know, he started speaking, and then all of a sudden the US dollar just took off like a rocket. So major technical damage done here. It does look to me like the market was setting up for kind of like a ABCD continuation pattern, lots of tops in here, and then boom, see you later. So I did find that interesting. And then as he was talking, the question was this just going to be a little head fake and then we puke out and dump? But you can see it's actually accepting higher here, even following his speech. So with this image here, we have to be thinking, I guess the very first thing we should always be thinking is extensions. So good old parking garages. Interesting how I have some old notes on here about resistance and support, but I would be thinking something like that. Be interesting. Will come. Mind you, this is a 4-hour chart. I guess that's not bad. Anyway, I would type in here parking garage. So my knee-jerk reaction here, seeing this image, is we're probably heading up here. So that's an interesting twist. I don't think a lot of people were expecting that. What's the market's job again? The interesting thing is I have been, if we look at my other pages, this US dollar has actually been a lot more stubborn than I've been anticipating recently. And you can see it's, I guess you could argue there was an inverted head and shoulders that was put in on this thing, and that did break out, and all we did was come back and check that pattern. And now with that 4-hour bottom, those extension levels probably going to start shooting us up. Yeah, well, 1.618 to 2. It's going to take us back to this trend line. I think that's a pretty important trend line. That would make sense. But I'm a bit surprised, to be perfectly honest with you, because I do believe that this harmonic pattern is trying to play itself out. But this is a very, very big pattern, right? It started in the days of this nonsense. So it is fascinating to hear Jerry talk about, the inflation of a few years ago. People are just not going to be happy with that. Well, remember, this is all about money printing. And I think that the Fed has absolutely no interest whatsoever in ever thinking about the money supply actually going back to those old levels. But anyway, the point with regard to sort of the fiat currency proxy, the US dollar index, this whole sort of, con job of what is money in your pocket world that we live in. From a harmonic perspective, I was fully expecting us to trade back down to this 786. I do like the idea, though, that actually we're going to have one more wave higher in the stock market and, risk assets. I really actually wouldn't even be surprised if crypto all enjoys a really nice window here through the first part of 2026. And that, the final dump capitulation of this US dollar index, capital flowing into other currencies around the world. I think that happens next spring. So in the short term, I'm pretty comfortable with this inverted head and shoulders objective up top here on this US dollar index. It seems to me that that's where she wants to go in the near term. Suppose you could also argue that there's probably should be like a 38.2 retracement of this range. I don't even know where that would be. Where's Colin? Where are you, Colin? There you are. Oh, yeah, look at that. So it looks like a move up into this area heading into the end of the year. I kind of like that thinking. Also, too, you heard from Jerry talking about the lack of the data drought. I love that, eh? So I think this whole U.S. government shutdown stuff is going to sort of be a detriment to economic growth going forward from like an inflation perspective. I think it's going to be, and all this tariff crap, I think it's going to be contractoratory, if that is such a word, which I think also too helps the US dollar index as well. And I mean, you look around the world, I mean, do you really want to be going and investing a pile of money into Europe right now? Oh boy. I still don't quite understand why the euro has been as strong as it has. So if anything, seeing what we saw out of Jerry and the Feds here through that Fed announcement, I think that sort of reinforces that. Looks like the US dollar wants to move up. Some pretty wild gyrations in the commodity currencies here. And of course, you can see the gold and the oil moving all over the place here. I think what I found fascinating, and I was going to try and mention this before we got the broadcast going, but I think the rational investors proprietary signaling system, the breadth indicator, and this is really a culmination of my life's work. I think it actually sort of warned us that there was problems in the bond market. And you heard me constantly talking in the broadcast about how watch the bonds, watch the bonds. The bonds they couldn't find a friend through that whole Fed event there. And frankly speaking, that's a very dangerous message from the bond market. So, I've been sitting here humming and hawing about this silly January barometer and how we had a sort of initial shot across the bow with the Dow losing 800 points, but then it just instantly turned right around and made new highs. I think I've said recently, I'm a little concerned about this stock market rally because this is, in essence, a classic Dow theory sell signal. Mr. Charles Henry Dow would not be impressed with that whatsoever. And you also heard me talking a little bit about how energy prices seem to be turning back up. And if we have energy prices turning back up, I don't really see it in earnest on the weekly charts yet. So I think it's still sort of trying to find a footing. It's interesting to see natural gas prices have put in a very solid weekly W here, though. And interesting too that things like the grains, of course, the soybean farmers bitching and complaining in the States about Trump throwing money away, giving the soybean farmers in Argentina big bailouts. Where's our bailout? And I think Trump's desperately trying to do something with the Asians right now to get them back on the buy side for U.S. grain markets. So, and actually, we are in the end of October. This is fall harvest. So this is exactly when prices should be weakest. I actually really like the idea, especially this soybean chart of playing the seasonal nature. Buy in the middle of November, sell the middle of March, April. It made money 9 out of the past 10 years trading the grain markets. And into fall harvest, it makes sense. Prices are weak. So if you're looking for a trade, and it's interesting to see what the corn market's doing here. You can see how corn's, it got absolutely destroyed here. But, speaking of harmonics, I actually think this is a harmonic on the corn prices. 88.6, I suppose, would be our magic number right down in there. Hey, look at that. Son of a bitch. So if you're looking for an interesting trade idea, maybe take a good look at the grain markets here. Not very crypto, sorry. But that, I'm a fan of weekly W's. If I saw weekly W's out of the corn, ironically enough, out of the corn, I would be more than happy to buy. But there's no freaking way I could buy these markets. They're all going parabolic. And ironically enough, everybody was expecting Bitcoin to go parabolic through this particular cycle window, but it was gold and silver's turn this go round. But I can't come in on the buy side looking at those markets. That's insanity. This is what I want to see. Hey, isn't that interesting? I'm giving you guys actually like a TA 101. I mean, this is absolutely textbook. What do you think the odds are this bottom came in a reload zone? Ever heard that Beamish guy talking about reload zones? Look at that. Absolutely textbook. And if you showed me a Bitcoin chart that looks like that, I'd fucking buy it today. But Bitcoin doesn't look like that. Son of a gun. Look at that. Actually, I think we might even be getting W's on other sides of trend lines. Oh, look at that. Son of a gun. Soybeans are a buy. Actually, it's so funny listening to Larry Williams because, man, I've traded beans forever. And Larry Williams he basically made his career as a commodities trader through this market. And it was so funny listening to some kids interviewing him on like stock charts, not even knowing that this even existed. And they were joking out with him, "Oh, you ever made any money in soybeans?" And he's like, "Fuck, I made $1 million in 1 year trading beans." And what I've been telling my audience recently, and this is actually a really, really good visual demonstration of the Great Reset. Thank you, Klaus, and all the international banking cartel for screwing us over, just like you did to my hero JC a couple thousand years ago. The more things change, the more they stay exactly the same. So hopefully what you can see is that this market basically was range bound all through this generational cycle. And it's pretty straightforward. Now, thanks to our great resetting, hopefully you all see that now this is our new world that we're living in. It's fascinating to see this stuff from the big picture. And you look at an asset like this, copper is the same thing. I used to trade copper for years and years and years. Copper was always 60 cents to $1.20. You buy it at 60 cents, sell it at $1.20. Now it looks like they literally are going to say copper is a buy at $6. I don't know whether that's the new floor now or not, but maybe it's probably more like $2 or $3, and the top's probably like $10 a pound now. Anyway, so I think this is a very good visual representation of our society being great resetted. I don't know whether it's an actual 10-to-1 ratio or it's maybe like a 2 or 3-to-1 here through this particular cycle, but I think that image speaks volumes. So, interesting. And of course, you have heard Taco barking about soybeans to the Asians and stuff. And I think this is going to be one of the big sort of criteria of Trump deals and stuff is China comes back in on the buy side on the grain market. So if all of this, and it makes sense, right? This is by the rumor. So if all of this China Winnie the Pooh nonsense talk that is going on right now, if these talks collapse and nothing really comes out of it, these grain prices are probably going to come right back down to the ground. And of course, if you want to buy, think reload zones, Wyckoff checks, don't chase, right? Anyway, interesting market. On this weekly basis, still no stopping for the stock market, but the problem is can you buy markets that look like this? I don't know. It's the same kind of conversation as the gold market. I mean, if you're a gold bull, I've got lots of gold stock on the books. I love gold stocks. I used to be a VSE penny stockbroker. I mean, I played gold stock since the days of Bre-X. Actually, since the days of Murray Pesum. Let's see if there's any old timer on the YouTube channel who know who the hell Murray Pesum is. So anyway, I can't buy that kind of market. I'm more than happy, and this was the comment that I made about Bitcoin and crypto recently. I'm more than happy to let you have my bags at higher prices. If you want to keep taking these things higher, I'm more than happy to let you have my gold stocks, let you have my cryptos at higher prices, right? The sell halves on doubles, blah, blah, blah. But I can't buy markets that look like that. I can buy markets that look like soybeans. Wow, interesting. So, and also an interesting takeaway of late, I've been noticing natural gas usually bottoms when we get close to recession. So, and actually does fairly well through recessionary environments. And I've also noticed too that from a sector performance perspective, which has it has me scratching my head a little bit here of late, in that actually one market that'll do well if natural gas does better. Of course, the Fed's lowering interest rates is the utility sector. So this is also another sort of anecdote. If I can just, okay, this is to the end of the month. If we just look at the first 2-week study of the quarter, and I mentioned this in the daily videos on the site, first 2 week study. There's the first week, and then I actually dragged it into the options expiry. Utilities dramatically outperforming. This actually implies that we're like, uh-oh, where the hell are we? Are we actually heading into recession, into a bear market here soon? So we got the we got the defensive part of the market outperforming. And we've got Dow theory sell signals that there's problems. We have natural gas starting to bottom and look bullish, which usually does well when the broader economy is not doing so good. I mean, you heard Jerry today talking about how, well, the labor market's looking a little grim. US dollar usually rallies as sort of a flight to safety. I want to get the hell out of risk and just go bury my head in the sand. I think for quite a bit recently, the bury your head in the sand trade has actually been the gold trade, but this gold market just got way, way too far, way too fast. And I've also suggested to people, if you're a gold bug, what you should really be watching is the Swiss franc, because the Swiss franc really trades off of gold prices. So you tell me, does that look like weekly W's, like down in here when this was doing this up in here? Down, up, down, breakout. Oh, look at me, I'm a bull. Does that look like that now? I don't think so. It's interesting how we did have one head fake top come in here, then the market put in a bottom, then we went back up top and up, down, up. I tell you, if this thing tips over through this level here, whatever the hell that is, this is now, interestingly enough, this is actually a smile within a smile. Very dangerous. So you can see we've got that smile in there, and then this bigger smile up top here. So lots of anecdotal warning signs out of the proxies that if we were inflating, if we were growing, if we're rocking and rolling, this thing should actually be pointing higher, but that does not look bullish to me at all. So be careful, all you gold bugs. Dangerous market. And unfortunately, I do think to a certain degree, crypto, I think crypto itself, for whatever it's worth, Ethereum's, all the shit coins, all that, I think they're basically lumped into kind of the NASDAQ and the Russell 2000. Jesus, look at that. They're taking the Russell 2000 apart here, right? Remember I said before we got the broadcast going that, there was something wrong with this rally and that the Dow is making new highs, the S&P, the NASDAQ. This is scary, eh? Look at that, 8s and 9s on the Tom DeMark. And this is what I left off with before Jerry started speaking there. And look at all these damn divs that are all building here. There's trouble brewing in paradise, I'll tell you that much. But look how the Russell 2000 is actually like puking out here. So we might have a situation. Yeah, look at that. The Russell 2000 now down 1.5%. And the only thing that's keeping this whole sort of fugazi pawn scheme going is the AI. Woohoo! I don't even know how the hell you describe what the hell's going on here. Because like Oracle just announced we're going to spend money on data centers and we're going to borrow. We're going to go into debt to build these data centers. And that was exactly what killed the dot-com boom. So we're starting to hear the smatterings of this is not this growth, this building out of the economy. It's not being financed through profits. Now you heard Jerry speaking about Nvidia and how all of their investment is coming out of profits. But there's sort of early tells that actually a lot of the investing that's being done in the AI is actually just circular. Well, we'll give you 1 million of our shares, you give us 1 million of your shares, and we just did I guess billion these days. We just did $1 billion transaction. Oh, look at that, we're all rich, right? So the AI story, I think ultimately it's washout, which I think comes maybe the end of 2027, well, the end of 2026 through 2027. So like a good year or two away. That actually, when that part of the market washes out, that will actually mark the bottom of this cycle and we start the whole new cycle again. Right now, these guys are all full of piss and vinegar. I've been talking in daily videos about these damn semiconductors, all just strong as shit. Excuse my French. And they're just going for it. Look at AVGO going for it. Look at NVIDIA going for it here. Are we getting maybe a little nosebleedy here? If anything, if you want to sort of have the ultimate leading indicator for the economy and for the stock market, that's the semiconductor index. And we got a big fat doji here today. But that's it. It's just a doji. I suppose you might argue, although I don't think this is valid. No, I'm not even going to bother. What I would say here is I kind of like, maybe even off of this base, A to B. Boom. Always drawn backwards. C to D. So if the inertia of this market just keeps going, but we got plenty of signs that there's trouble, then you're probably going to see this guy work his way up. Probably, hell, I wouldn't even be surprised. I suppose we got to crisp that up a bit. Actually, well, maybe I'll go off of that swing high there. Somewhere up in that area. I wouldn't be surprised if we work our way up into there. You could probably also do some chaos theory levels here. So as long as this thing is pointing higher, now this is getting a bit ridiculous. I mean, just gapping higher every bloody day. But as long as this thing's pointing higher, I wouldn't stand in front of these AI names. I think you're asking for trouble. So 2.618, probably a logical objective here. Off of that bot setup, move stop to a trailing level hit. So had you had the balls to step in off of this reversal, you shouldn't lose any money on this. But could anybody forecast that this is what was going to happen? I doubt it. There is that low to high trend line that I just drew. There is the bot take profit objective. So I don't know what the hell the top of this market's going to look like. But my hunch is it's probably going to look something like that, right? So you got to wait for that kind of thing to happen. Right now, all this is just indecision day. And keep in mind, in about even less than that, in about an hour, all hell's going to break loose here. So you ready? We've got, after the bell here today, we've got Microsoft, Meta, and Google all hitting us bang, bang, bang in your face. And then tomorrow, Amazon, Apple, and Coinbase. So, and Reddit now is a thing in the stock market. Man, that's screwy. So the point of the matter here is we're right in the heart of earnings. Microsoft actually has a pretty aggressive bullish bot setup working. Meta actually has a bit of a top. Google just looks like a runaway steam train. So if these guys all report half decent numbers, then I don't see the orgy ending here. And my hunch is it's probably going to be a reaction of that. So if you're looking to time the market, all that kind of fun stuff, maybe see how these names act over the next day or so. And then we'll get an idea of whether there's more inertia behind this move. Probably finish this off with just a quick boo at Microsoft, for example. Where did I have him? He's around here somewhere. Oh, Jesus, look at Palantir go. So PayPal Mafia is feeling pretty good about themselves. Oh yeah, there's that Microsoft. So look at the size of this. And, I mean, these guys now are hip deep in AI. So they're going to start reporting some insane numbers here after the bell. But you can see there's the entry. I could easily see this stock just go fucking ape shit here. Excuse my French. So let's see how these earnings play out. Anyway, I think that's my report here for you all. I know you all want to be uber bullish of Bitcoin. I suppose I'll finish off with that. The worst part about that, unfortunately, is I think we have actually a very wide fractal pattern playing itself out here now. A billiard ball fractal. What does random actually look like in this universe? Well, it kind of looks like that image. And so you can see big down, right? That's what all this write up is. That's that move. Then big up, then a little ME, which is that, then a dump, which is that, then a sideways, which is that, then a rally back to these levels, which is what we just saw. Then a dump. Do we have to go all the way right back down to these lows? Maybe. Then we find some sort of stability. And of course, there's good old reload zone. So I guess that would make sense. And then we turn right around and blast through all of this, heading up to new highs. So if you are interested in hunting a Bitcoin long setup, I would definitely have your spidey senses active here. I think we have trade location down here. So it's just a question of following the Licks principle. If you don't know what the Licks principle is, maybe consider joining my education program. And I can teach you. But is this appropriate trade location? It's interesting how we're coming into 4669s here. So I would, like I said, spidey sense is active. Let's hunt for bullish momentum divergences. Then let's hunt for W's in price to frame risk. And hell, we might be right back on the bull side. For the time being, I think the most recent trade was a short off of that important resistance level fail. 2 to 1's already been hit, so majority of profits should be taken. Should have runners on if you want to keep staying short. But like I said, I actually like the idea of now starting to go into a long stalking mode here. And I wouldn't be surprised if this plays out over the next maybe 2 or 3 days. So that's what I'm thinking. All right, everybody, have yourselves a fantastic rest of your day. PMA for the win. Slow and steady wins the race. Remember what your number one job is. Try not to take no win nickels. Well, the only left Brian say to you, good people, is bye for now.